Next, let's turn our attention to the income statement. So the purpose of the income statement, of course, is to show profits and losses of the business. So we're showing profit generating activities, and then the income statement is showing a particular period of time. So that's why you'll see for the year ended, or for the quarter ended, or month ended. So it's a change statement showing what's happening over a period of time. It lists the revenues earned and the cost of earning them. So expenses are the costs of generating the revenues. And so what we want to do is apply the matching principle. So the matching principle applies here, and that means that we are matching the costs of generating the revenues to the revenues earned in the same period of time. And the income statement, of course, shows revenues minus expenses to get us net income. The income statement has a lot of usefulness, of course. It's kind of understood that it can help us to show the profitability of the company, right? It's also helpful to evaluate past performance of the company. So we can look at, what was the profit from previous accounting periods, and then that actually helps us to predict future performance. So we can see if there's some kind of pattern that's emerging. It can also help us to assess the risk or uncertainty of achieving future cash flows. So you can look at the revenues that were generated, and that's going to kind of give you an idea of what types of revenues we could expect to occur in the future. And then we can also compare that if we pull in the balance sheet, it also, and look at accounts receivable, it helps us to see what types of cash flows we could expect to happen in the future. The income statement, also has some limitations. So it's an estimate, and there are lots of estimates that go into the income statement, and so we'll talk about those throughout the course, and we'll also talk about each of those estimates separately, and then how they affect the income statement, net income specifically on the income statement. So there's a number of assumptions and estimates that go into this, and so that's a real limitation. So let me give you an example of that. We may estimate that some of the credit sales are not going to be actually collected in cash. And so that's called bad debt expense. And we'll talk about that a little bit later in the semester. And so bad debt expense is a reflection of how much of those credit sales we think we won't collect. And that is an estimate. We don't know. We don't have a crystal ball, so we can't look into the future. And so we have to just kind of estimate that. And so our estimate may be overstated or understated. So, for example, we may estimate that 2% of credit sales are uncollectible, whereas in actuality, it may work out that 3% is uncollectible, or 1.5%. So these things, so bad debt is an expense. So remember, expenses will decrease net income. And so if we overestimate that, we would decrease net income by too much, right? And so net income would be understated at that point. So these assumptions and estimates do affect the income statement. It's a definite limitation of that particular statement. The other thing is that items that we can't really measure reliably would not be included in the income statement. So if there's revenues, let's say that we've signed a contract with a customer, but it's not really clear to us if we're really going to actually be able to collect on this particular contract, then we would not record that revenue at all. And so that's revenue that we may end up collecting it in the future, but it wouldn't be recorded on the income statement, because if we can't reasonably expect to actually collect it, we're not allowed to put it on there. The other thing that you might see as unrealized gains and losses, and those go in other comprehensive income, but they're not they're not reflected in net income. So for example, if we invest in another company, we purchase some shares of stock in another company for $2 a share, and then they start trading on the stock market at $3 a share, then the gain in the value of that investment doesn't get reflected in net income until we actually sell those shares. And so it goes in other comprehensive income. It gets reflected in the equity section of the balance sheet, but it doesn't really get reflected in as part of net income. The other thing is, if we do some things that would help brand recognition, let's say that we create a new logo, for example, for our company. Anything that is created in-house doesn't get recorded as a cost of doing business, and so the value of that or the is not really going to be reflected. If we use different accounting methods, we may end up with different values for expenses. And one example of that is depreciation. And we'll talk about that a little bit later in the course, but we could use different methods to calculate depreciation, and depending on which method we use, we're going to get different figures for the depreciation expense. So this is really important for you to understand as a finance person. If you are analyzing the financial performance of a company, it's important for you to understand which depreciation method they're using. If you're, for example, if you're trying to compare company A and company B, if they have similar asset structures, but they're using very different depreciation methods, they're going to have different measures of depreciation, and that would impact their net income. So we'll talk about that a little bit more later on in the course, but it's important for you to understand that as a limitation to the income statement. The income statement format is also classified, meaning it's grouped according to common characteristics. And so what you're going to see is operating items separated from non-operating items. So operating items are the things that are directly related to whatever it is that we typically do in the company. So these are transactions that occur due to the normal course of business, whereas non-operating items would include some gains and losses and revenues and expenses from other things that aren't directly tied to what we normally do. So for example, let's say that we have a manufacturing company, and so operating costs would be the cost of depreciation on that manufacturing facility, for example, or the salaries and wages that we're paying to the people who are working on the factory floor. If we found that we had some excess capacity in our manufacturing building, and we decided that we were going to rent out some space to somebody else, so we let another company come in and manufacture something else utilizing that space, then that would be considered a non-operating item because it's not really part of what we normally do. And so the rent revenue that's generated from renting out our excess capacity would be listed separately from operating items in a section below that for non-operating items. The income statement can be formatted in one of two ways. It could use a single-step format or a multiple-step format. So what you're most likely to see is this multiple-step format. The multiple-step format just provides you a lot more detailed information. So let's start with the single step. So single step has fewer headings and classifications. It's really easy to prepare. So what you see is that you're going to see all of the revenues listed together and all of the expenses listed together to get, so this is revenues, this is expenses, revenues minus expenses equals net income, right? So they all just get grouped together, and so there's no classification of operating and non-operating, for example. And then when we get to so the single step income statement is totally fine, you can use that, but it really just doesn't provide you a lot of really detailed information. whereas the multiple step income statement provides a lot more information. So what we're going to see here is we have an operating section of the income statement. So it separates out, so I'm just going to kind of do this. It separates out income from operations, and then this is all the other kind of peripheral stuff, right, that we're generating revenue from or having expenses due to. And so this actually gives us information about net income or loss from operating the business. So under normal, operating conditions, this is our net income from doing all the stuff that we normally do. And then below that, you have income from other stuff. So we can, if we separate that out, it really gives us a lot more detailed information. So we can see what's the income that we are able to generate from doing whatever it is that we normally do. And then if we have some other stuff that we're also doing, like renting out part of our warehouse space, for example, we can see what income we're able to generate, or what are the costs associated with doing those other peripheral types of things. So it just provides us a lot more detailed information. So that's kind of the discussion about the income statement. You can click next and you'll have the opportunity to have some questions, answer some questions about the income statement, kind of assess your understanding of what we just talked about.